Good morning here. Welcome to our first active. Here's the breaking news. Yes, every few days for the past several weeks, a parade of Chinese leaders and policymakers have publicly vowed to do more to boost the sputtering economy, usually by promising to support the Belgrade private sector. Sometimes investors appear to have gained confidence from these pledges, sending shares higher. More often, though, they have ignored the flurry of official messaging, hoping for more tangible stimulus measures that economists and analysts tell CNN are now unlikely to come because China has become too indebted to just pump up the economy like it did 15 years ago during the global financial crisis. We have had plenty of vague promises already, which don't amount to a great deal, so said Robert Kernel, regional head of research for Asia Pacific at ING Group. Except for some incremental steps to help the property market, currently mired in its worst slump in history, and tweaks to interest rates, there have been few signs of the government providing real money to struggling consumers or businesses. Chinese policymakers appear unlikely to enact any major monetary or fiscal stimulus, likely fearing doing so could exacerbate China's growing debt risks, said Craig Singleton, senior China fellow at the Foundation for Defense of Democracies, a Washington based non partisan think tank. At most, we can expect meager, mostly supply side measures, ostensibly aimed at, among other things, attracting more private capital and boosting electric vehicle ownership, he added. After a strong part to the year after COVID restrictions were lifted, the world's second largest economy has lost momentum. Since April, a slew of disappointing economic data and population statistics has sparked concern that China may be facing a period of much slower growth and possibly even heading for a future comparable to Japan's. China's economy barely grew in April to June months compared with the previous quarter as an initial burst in economic activity following the end of pandemic restrictions faded. Signs of deflation are becoming more prevalent, sparking concerns that China could enter a prolonged period of stagnation. Based on Japan's experience in the 1990s, there is the risk that China is entering a liquidity trap, a scenario in which monetary policy becomes largely ineffective and consumers hold on to their cash rather than spend it, said Alicia Garcia Herrero, chief economist for Asia Pacific for Netflix, a French investment bank. In other words, there is a risk that Chinese corporates and households, pushed by their very negative sentiment about the economic outlook, prefer to disinvest and deleverage in the light of falling revenue generation. Yes, even if Beijing were to take action, it would be less effective than 2008, Garcia Herrero said. An infrastructure led fiscal stimulus would need to be much bigger to have the same economic impact, he said. It also implies that if action is taken, public debt in China would jump well above the current 100% of GDP, which would place the economy among the most indebted in the world, she added. What's worse, under President Xi Jinping, Beijing appears to have doubled down on its strategy to strengthen the party's control over the economy, analysts said. A correct response to the economic slump would be for Beijing to return to a pro-market reform path and let the private sector play a bigger role, according to Derek Scissors, senior fellow at the American Enterprise Institute. Bien, that's it for